Hey guys, welcome to another video by Fully Informed Trade, or FI Trade for short. My name is Alex and I'm just going to go ahead and talk about the markets, primarily the stock, commodity, bond, and Forex markets. So, without further ado, let's go ahead and examine the dollar. And pretty much the dollar is reacting very interesting right now because first of all, we have this head and shoulder, not really a head and shoulder, but we have pretty much pretty much we're going to have a double topping pattern right here, and we're going to most likely pull back to the neckline, which is going to be right around $79. Again, most likely that's going to be the case scenario that we should most likely anticipate. However, in the short term, we might be able to push right back above the 20-day moving average, although I find it unlikely because chances are we're going to go ahead and close below that and try to find support at $79 eventually. The next support level will most likely be $78. So keep those levels in mind. It was either going to be, and I mentioned this in my previous video where I had a double top, and either it was going to be the 83.50 to the 81.20 range, or it was going to be this. And a double topping pattern. And a double topping pattern, it looks exactly like this. You got one top, two top, and then it pulls back. But pretty much, let's go ahead and talk about the stock markets, review what exactly happened, get a basic idea of how each index has performed. Let's go ahead and look at the Dow Jones Industrial Average with a 0.72% gain, S&P 500 with a 0.90% gain, and the Nasdaq Composite with a 0.75% gain, New York Stock Exchange Composite with a 1.3% gain, Nasdaq 400 mid cap with a 0.64% gain, S&P 600 small cap with a 0.97% gain, and the Russell 2000 with a 0.83% gain. Overall, New York Stock Exchange Composite stocks did very well. They did perform better than the stocks on the Nasdaq. The smaller companies did perform better than the larger companies in certain aspects, but that's the small companies. Mid-cap stocks, basically companies with a valuation of around 1 billion to 10 billion, didn't do as well as the Dow component blue chips companies or the S&P 500 for that matter. So let's go ahead and look at the sectors and get a basic idea of which sectors did perform better for the day. First of all, the best performing sector was the financial sector with a 1.68% gain overall. Then following that is the energy sector with a 1.37% gain, and then following that you pretty much got the materials with a 0.98% gain. Basically, stocks that were working in the commodities such as gold, silver, copper did perform better, and that does get me back to what's been going on in Australia, because the Australian open pit mines, they really can't mine because they got flooded. When you have a flooding mine, there's just too much water comes in. A lot of material gets buried in it. You create landslides. You make it very difficult, and the sheer cost of fixing all those issues is going to be very expensive. But more importantly, the amount of time it will take will take a while to fix. And a negative 5% of steelmaking coal from world markets will be taken out of the markets and will no longer be produced during the duration it takes to fix those coal mines down in Australia. So pretty much the materials did better, especially in the coal area. Silver did pretty good today, which made silver miners some extra money. And also oil companies did very good because of a weakening dollar. Weakening dollar causes the value of oil to go up. Oil companies benefit the most from a rising from the rising price of oil. Financial stocks have gone up by around 1.68%. One can speculate just because of the fact that a lot of these banking stocks are going to be reporting by next week. So pretty much we got some good, we got a huge bulk of earnings coming in, and remember, the hype always reaches a pinnacle towards the end of a rally. So pretty much you can always anticipate more momentum towards the very peak instead of towards the bottom. So basically what we're anticipating right now, or what I'm seeing right now, is that the XLF Financial is performing much better just because there's a lot of hype being added at the very last minute. So let's go ahead and review the next chart, which is going to be the XAU USDO. And pretty much we have this market that can't break above the 20-day moving average. And if it does break, which it probably will, but the only issue that I find here is that the gold market hasn't been able to break the 20-day moving average even after the dollar has been able to pull back. However, we got a slow stochastic divergence with the percent K crossing above the percent D. We have an oscillator that makes an indication of that likelihood is that we're looking at a trend reversal for the short term and most likely a relief rally, I anticipate something around here, around 1,410 or something. Most likely have a head and shoulder pattern complete, and then you can anticipate the market pulling back below the multi-year channel line, which I don't have enough time to go ahead and show you right now. But you guys will get a basic idea if you go ahead and watch my previous video on that multi-year channel. Let's go ahead and review the XAG USDO, which is pretty much a silver spot on the Forex market, which is a commodity slash Forex position, I guess you could call it. But pretty much, you're looking at the same story here in the silver market. We continue a little bit higher, but we're still having some trouble breaking that 20-day moving average on the longer-term chart. Because of that, I can't feel too optimistic until we can go ahead and get a confirmation close above that 20-day moving average. And once we do break above that 20-day moving average, there would be some limited upside. But remember, the risks are high going into silver at this point, since we are at the upper ends of a multi-year channel. And because of that, it should be treated as a short-term trading opportunity, not necessarily an investment opportunity. Because even if we were to invest at these highs, if you look at historical trends, it generally averages around 2 to 3 years for you to make a positive return when you buy at the very top of a multi-year channel. So the risk does not justify the reward if you're a longer-term trader. However, or a longer-term investor for that matter. If you're a trader, right now it's just a quick, if it breaks above the 20-day moving average, you could either anticipate a head and shoulder or a double topping pattern. Either of the two would be fine, and by then you should have liquidated your position. And let's go ahead and look at the next chart, which is pretty much the crude oil markets. And the crude oil markets are very interesting because you pretty much got the crude oil continuing to go higher just because of the dollar index having its minor pullback. And if you want to get confirmation on that, we'll just go ahead and look at the dollar index chart. Right now we have like this red engulfing bear candle on the dollar index. You can see the very opposite of the crude oil market, which has one engulfing pattern, and then you have a semi-engulfing pattern right there. But overall, you have this positive momentum in the oil market, which is an amalgamation of a couple things. But the oil pipe in Alaska has already been fixed and it's already operational, so all that has already gone past. But that news out of Alaska did help pump oil prices initially before the value of the dollar index went ahead and pulled back. So pretty much what you got here is a crude oil market continuing to most likely go a little higher, and the companies that are going to most likely benefit from that are companies like ExxonMobil, Chevron, and stuff like that. And I've been liking ExxonMobil just because of its safety, the safety play that the safety net that you get from being instead of a well-managed and safe company with pretty good yield growth over the longer term. But more importantly, a lot of investors have been bidding up this monstrous-sized company. I mean, just to give you a basic idea of however much ExxonMobil is worth. It's a $386.1 billion company, and it has already appreciated by quite a bit. Now you might think, well, you know, Apple has done better, but in the oil industry, this generally doesn't happen. A stock that was at around, give or take, $60 in around August of 2010 is currently trading at around $75. That's give or take about, I guess, a 25 to 30% gain. And to increase the market, and just get a basic perspective on how much market value has increased, you're looking at a basically somewhere around 100 to 80 billion dollars in total market valuation. That will basically a total appreciation on the total value of the company. So overall, I feel that ExxonMobil is still good, and I feel that you know, over the longer term, you could find some decent yields, some great yield growth. But more importantly, if you want to play the oil market and you don't want to be exposed to commodity futures, ExxonMobil is the way to play it over the longer term. However, I do find that it's a bit overextended on the charts right now, and anything that could derail the markets, anything coming out of China, anything coming out of Asia, anything coming out of Europe, could derail the market recovery, on top of the fact that we have an earnings hyped rally. Let's go ahead and examine the next chart, which is pretty much the bond market. And the bond market pretty much reacts negatively as the stock market continues a little higher. If we go ahead and look at the Dow Jones Industrial Average, you get a basic idea of this by looking at a 6-month chart. You have this bullish engulfing pattern, and another thing that you want to keep your eye on is the fact that we've been able to make new highs for the year to date, which is some great progress. If you go ahead and look, in response, the bond market responds negatively to that. So we got to watch that correlation very carefully. And the reaction between these correlations are not going to be aren't going to be they're not going to be perfect ratios. They're not going to happen in a synchronous manner all the time. You're just going to find a reaction, and it's not always going to be equal. For example, if gold went up by 3%, that doesn't mean that the value of the dollar would go down by 3% in response. You're going to get a response from the market, but that doesn't mean that it's going to be equivalent in response to it. So all you're really looking for in this correlative analysis is a response to one event to another, and that's about it. And as far as making a trade, you should be looking at each individual chart, watching those support, watching those resistance levels, watching those moving averages, and using whatever indicator to make a great decision. On top of that, if you're going into something more specific like stocks, if you're looking at the Dow Jones Industrial Average, that should be something to give you a basic idea of how the markets are performing. Then you should look at the specific stock you're working with, and you should look at the overall market trend. And if they're in line, then you might make a position based upon a dollar index devaluing. So all you're looking for in this correlative analysis is a response to another response, and that's about it. As far as being more specific, you'd have to do much more independent research on your own. And that does it for me today. Please be sure to check out the link above or below this video, and if you're on YouTube, please be sure to subscribe. It helps me so much for all of you guys out there. And for you guys on Facebook, I'd appreciate it if you guys tell your friends about me, tell them to go ahead and add me on Facebook. I'd love to talk with them about investing and give them a couple tips or two. And that does it for me for today. Please be sure to keep on checking out my videos, and I appreciate so much of the support that you guys give me. Thank you so much.